Hi, Gabriel Josiah here. Okay, today we're going to be looking at our discourse on financial statement analysis. In the last class, we looked at Unit 4. All right, so today we'll be looking at Unit 5 of that same discourse. Let me share my screen quickly and we'll dive fast into the financial statement analysis. Okay, talking about the types of financial analysis, which is our subject in Unit 5. Basically, there are various types of financial statement analysis, which includes external analysis and internal analysis. External analysis has to do with an analysis carried out by an external party to the entity. And the entity's published financial statements form the basis for this analysis. So look at it this way. You are an audit senior or a partner in an audit firm, and you are giving the financial statements of a publicly listed company or a limited liability company to analyze. So that's what it means to perform external analysis. So you are in the audit firm, but you are not performing analysis for the audit firm, but it's an external party who has contracted the job out to you to perform. So expressly, that's graphically what external analysis means. It's carried out by external parties to an entity of either published financial statements or management accounts, as the case may be. Also, the internal analysis, like I explained, is carried out by the entity's financial managers to provide information to top management for decision making. So, for example, you work in ABC Company Limited, and you are given the financial statements, or you are instructed by your boss or your employer to analyze the financial statements of that company where you serve or you work. So the information is for top management decision making, and that is what the internal analysis is all about. So the external has to do with the firm outside your company, and you are analyzing their statement, while internal is where you work and you're doing the analysis in the company. Very simple. So we also look at short-term and long-term analysis. So a short-term analysis is concerned with analysis of an entity's working capital. Now, the working capital is the interrelationship or interconnectedness between the current assets of the company and the current liabilities. So you're looking at how you are able to run the company on a short-term basis. Working capital management is essential to running a company very, very effectively, because you are trying to meet short-term obligations, which are very paramount to ensuring smooth and stable and also seamless operations. So your current asset has to be above your current liabilities to stay afloat in operations. This is very important to take note of it. So it involves the analysis of the entity's current asset and current liability to be able to determine the short-term liquidity or cash position of the entity. So it shows whether the entity will be able to meet its short-term commitments to run the company effectively. Now we also have horizontal analysis. This involves a comparative analysis of financial statements for a number of years. So you have, for example, 2020 financial statements, you have 2021, you have 2022, you have 2023, you have 2024. So that's a 5-year financial statement, and you're supposed to compare each year vis-a-vis the other year. It's very important. It's known as dynamic analysis. You are comparing each year to see the performance, what they did between those years in question. This type of financial statement analysis is called horizontal analysis, or is also known as dynamic analysis. Now we also have the vertical analysis, where you compare the calculation of financial ratios based on a single year's financial statement. So for example, we have 2020 financial statement, and we have a base, which is revenue. And we're comparing the revenue parameter with the cost of sales, for example, comparing the cost of sales, the gross profit. We use revenue as the base, then the gross profit, the cost of sales, the gross profit, and other expense lines as a percentage of the revenue to see how much the expenses are gulping and how much you are able to retain as the bottom line. This is very important. So vertical analysis also helps us determine our bottom line or our net income, our profitability as a percentage. So it's the calculation, again, of the financial ratios based on a single year's financial statement. This is also known as static or static analysis because this is a 1 year review you are performing as a chartered accountant. Take note of this. These kinds of financial statements come very graphically in the case study exams for candidates. And looking at past questions, the Pathfinder of the Institute of Chartered Accountants, the examiner has been testing horizontal and vertical analysis. So take note of this, and this will be the end of Unit 5, financial statement analysis, the types of financial statement analysis. We'll look at Unit 6 in the next class. All right, let me know what you think, or if you have any questions, just type them in the comment section and I will attend to them. Consider subscribing, also share with fellow students that are writing ICAM or somebody that needs an understanding on types of financial and statement analysis. Thank you very much. All right, and I'll see you in the next class. Bye for now.